with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. You'd call them secondary tariffs. You know what that means.
Ultimatum, concessions, and a brewing crisis? You turn on the TV and hear that the U.S. is preparing to impose a 100% tariff not just on Russia, but on any country still trading with Russia. Then you learn that Washington quietly allowed NVIDIA to resume AI chip shipments to China. Meanwhile, Japanese bonds are plunging, and Toyota prices are expected to rise. Is America now caught between three major pressures, and is each move carrying its own price? President Trump has given Russia a 50-day deadline to reach a peace deal with Ukraine. If that doesn't happen, he says the U.S. will apply a 100% tariff not just on Russian goods, but also on goods from countries that continue to trade with Russia, what are known as secondary tariffs. In addition, Congress is advancing a bipartisan bill that would slap a 500% tax on any service linked to Russia. For everyday Americans, this could stir up real changes in energy and industrial prices. If countries like India or China keep buying Russian oil or gas, and the U.S. starts taxing their exports in response, that could make everything from gasoline to electricity to construction materials more expensive. A 5 to 10% price hike may not sound huge at first, but it could add $10 to $20 to your power bill, or bump up prices on steel-based products you use every day like appliances, tools, or building materials. After months of tight export restrictions, the U.S. has quietly approved NVIDIA to apply for licenses to ship its H20 AI chips to China again. For many in the tech world, this signals that Washington may be reconsidering its stance, partly due to pressure from industry leaders, and partly because China's economic numbers are still strong. In the second quarter, China's GDP grew by 5.2%, and industrial production rose 6.8%, proving that its tech and manufacturing sectors remain robust. This move could benefit American consumers if NVIDIA ramps up chip production for both US and Chinese markets. Unit costs could drop. For example, a high-end graphics card that recently cost $500 might soon be available for $475 to $490. Good news for anyone into gaming, creative work, or small-scale AI tools at home or in business. Japan's 30-year government bond yield has reached a record high of 3.20%, while the 20-year bond now sits at 2.65%. These jumps are signs that Japan's internal financial system is under pressure. At the same time, President Trump plans to impose a 25% tariff on Japanese-made vehicles starting in August, posing a direct threat to major car makers like Toyota, Honda, and Nissan. If you're thinking about buying a new Toyota, brace yourself. That price could climb by $1,000 to $2,000, depending on the model. But that's not all. Many U.S. financial institutions hold Japanese bonds as part of their international portfolios. As bond yields fall and risks rise, lenders may increase borrowing costs, raise insurance premiums, or tighten lending terms. Small changes that could trickle down into mortgage rates, car loans, or even credit card offers. In short, while these international issues might seem far away, they could soon show up in very real ways in your energy bill, your next tech upgrade, or your next trip to the car dealership. Japan has formally rejected a request from President Donald Trump to increase U.S. rice imports, despite warnings of potential new tariffs. Could this firm stance trigger a deeper escalation in U.S.-Japan trade tensions? The Japanese government announced it would not sacrifice rice farmers to meet U.S. trade demands, even after former President Trump warned of new tariffs if Tokyo failed to increase rice imports from the United States. According to Reuters, Japan imported $110 million USD worth of American rice during the first 4 months of 2025 and nearly $300 million in 2024, a notable rise compared to prior years. Despite that, Tokyo remains committed to its 770,000-ton import quota under WTO agreements and imposes high tariffs on imports exceeding that limit, a safeguard intended to shield domestic agriculture. Japan's stance reflects not only economic policy, but also political strategy. Rice farmers, concentrated in rural prefectures, are a key support base for the ruling Liberal Democratic Party, the LDP, which faces an important upper house election on July 20. At this critical moment, protecting rural livelihoods and price stability is viewed as a higher priority than making external trade concessions. From a domestic perspective, Tokyo's position aligns with broader concerns about rising food costs and climate-driven supply pressures. With rice prices already under pressure from poor harvests and elevated input costs, Japanese policymakers are focused on maintaining stable agricultural output and shielding consumers from additional volatility. Since the 1970s, Japan has run one of the world's most extensive farm protection programs, including subsidies to reduce rice production. Though officially ended in 2018, the government continues to incentivize shifts to soybeans and other crops to control domestic rice output and prices. In 2024, extended adverse weather reduced crop yields, while rice consumption among younger generations declined. As a result, domestic prices doubled. A 5-kilo bag of rice in Tokyo now costs around $30, placing added strain on households with limited incomes. This shift affects more than grocery bills. Schools and urban families are rethinking traditional meals, turning to cheaper staples like noodles, bread, and imported grains. Long-term, such changes could alter the culinary identity of Japan. While current tensions center on agriculture, broader trade impacts are emerging. In response to tariff threats, Japan imposed a 25% duty on certain U.S. auto and metal exports. With no new bilateral trade deal in place, American industries now face both reduced market access and higher costs. The uncertainty has rippled into financial markets. In early 2025, the U.S. dollar experienced its steepest decline since 1973, driven by concerns over rising federal spending and failed negotiations with key partners like Japan. Meanwhile, Japan's Nikkei 225 index dropped 1.2% following Trump's tariff comments, reflecting investor unease over unclear trade policies. For American consumers, continued friction could lead to higher prices on goods reliant on Japanese parts and materials. States with strong ties to automotive and metal industries may also face job losses and stalled investment if tensions escalate without resolution. Canada is making bold economic moves as U.S. trade policies trigger a wave of responses. Could these changes quietly reshape what Americans buy and how much they pay? In 2024, the Trump administration imposed a 50% tariff on imported aluminum to protect U.S. metal industries. According to the U.S. Census Bureau, prices of aluminum products rose 22% within months. This hit American manufacturers and construction firms hard, especially those reliant on imports. Canada, which supplies over 70% of North America's aluminum, responded strongly. Aluminerie Alouette in Quebec announced a $1.1 billion plant modernization, powered by low-cost clean energy from hydro, Quebec. Quebec's economy minister stated, "The U.S. depends on U.S. for aluminum, and we won't stand by." For Americans, the effects are immediate. The price surge affects home renovation, auto repair, and beverage packaging. Costs on products like soda cans and appliances may rise, adding up to $2.5 billion annually for U.S. consumers. Small businesses in construction and manufacturing face tighter margins and difficult decisions. Canada is rapidly diversifying trade. In early 2024, non-U.S. exports rose 18%, while U.S. bound exports fell to their lowest since the pandemic. Gold exports to the U.K. jumped over 30%. Crude oil to Singapore hit records, and Italian imports of Canadian aluminum and pharmaceuticals reached all-time highs. Pork exports to Japan rose 13%, with Canadian food favored for its clean, traceable image. As Canada looks beyond the U.S., American buyers risk losing access to key supplies. From metals to pharma ingredients, weakening supply chains, raising costs, and reducing product availability. U.S. consumers may face higher prices or longer wait times for top quality goods. Canada's Industry Minister Melanie Joly criticized the Trump administration's trade tactics, saying, "We are in a tariff war, and negotiating with the U.S. is tougher than ever." She announced a three-point response: stronger anti-dumping rules, better liquidity support for industry, and faster project approvals, cut from 5 years to 2. Joly also introduced incentives to attract top researchers, noting Canada welcomes talent, especially as academic freedom faces challenges in the U.S. Canada's assertive approach may heighten competition for talent and investment. U.S. universities and tech industries risk a brain drain as researchers and students OPT for Canada's more supportive environment. This could affect American innovation and growth in tech, biotech, and energy. Canada is investing heavily in green energy, hydro, hydrogen, and advanced fuels to lead the global energy shift. High-value exports like battery tech, advanced materials, and aerospace are priorities. The goal? Commercial independence and freedom from Washington's changing moods. If Canada becomes a clean tech and export leader, U.S. industries could lose a key supplier and tech partner. That could mean tougher competition, reduced influence in North America, and, for consumers, fewer options, and higher costs for next-gen products like EVs and energy-efficient appliances.
If this continues on for any duration, we'll have fewer items to select from, some spot shortages, and likely prices will increase as they're affected by these tariffs from a host of countries across the Pacific Rim.
America's busiest ports are facing unprecedented congestion as new tariffs and supply chain issues collide. What will rising port congestion mean for the prices and availability of everyday essentials? The ports of Long Beach and Los Angeles, handling nearly 40% of U.S. container imports, are facing severe congestion, with dozens of ships idling offshore. The Wall Street Journal reports the main cause is a rush by retailers like Amazon and Target to front-load shipments ahead of a new 145% tariff on Chinese goods. This surge has overwhelmed docks and storage yards, already strained by labor shortages and climate-related disruptions like extreme heat and drought. Analysts from Bloomberg warn this isn't just a short-term issue. A mix of policy missteps, weather, and labor shortages is threatening the stability of U.S. logistics. For households, that means delays in everyday items and rising prices. Small businesses are especially vulnerable, facing inventory gaps that could lead to price hikes or even closures. Major retailers are taking bold steps to safeguard supply chains. Amazon now runs its own fleet, container ships, 90 aircraft, and over 60,000 trailers, according to CNBC. It plans to expand Prime delivery to smaller cities and rural areas by year's end to bypass port and distribution delays. Target is also reinforcing its hubs and speeding direct-to-store shipments to prevent warehouse backups. While big corporations can shield themselves with tech and scale, the broader public still feels the impact. Rural shoppers may get faster Amazon deliveries may, but local stores struggle to compete. This reduces consumer choice and deepens reliance on national chains, further weakening small-town economies. Beyond the ports, America's supply network is under internal strain. Reuters reports massive stockpiles at key warehouses in Chicago, Dallas, and Memphis, stuck due to shortages of trucks, containers, and labor. Globally, drought at the Panama Canal is forcing ships to reroute around Africa, adding up to 2 weeks to deliveries of goods from electronics to auto parts. These disruptions are far-reaching. Automakers and supermarkets face canceled orders and halted production, causing store shortages and price hikes. For small businesses, delays threaten operations, jobs, and survival. American families may soon feel the impact through reduced access to affordable essentials. The old model of cheap production, fast shipping, just-in-time inventory no longer works in today's volatile world, with persistent political risks, climate shocks, and labor disruptions. The U.S. supply chain's vulnerabilities have been laid bare. While giants like Amazon and Target can adapt, small and mid-sized companies often lack the funds and infrastructure to weather the storm. The consequences for daily life in the U.S. are profound. Unreliable supply chains translate to longer waits for goods, unpredictable product availability, and increased prices for everyday items. If systemic reforms aren't enacted to build resilience and flexibility, Americans could face continued shortages and disruptions well into 2025 and beyond. The stakes have never been higher for both households and local economies across the nation.